The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Fairly quiet and mixed activity in the grains and livestock on Tuesday. And really, if you blinked, you didn't miss much, is the way it seemed in these markets. Here to talk about things with us and give us his perspective as we are starting to settle into some early harvest activity and much more. Jim McCormick, agmarket.net, joins us here today on Market Talk. Jim, always great to talk with you and have a conversation. I hope things are going well.
Going well, Jesse. Thanks for having me on. We appreciate it.
Well, as I mentioned, things seemed fairly quiet in the markets overall on Tuesday. I know corn had a pretty decent day. Found a little bit of buying, at least holding some of this 475-ish level in D's corn, 476 at the close. Beans, wheat were down a little bit, but nothing really too crazy to write home about. It feels like maybe some of the early harvest doldrums, so to speak, in this grain market, Jim.
I think that's what it is. A couple of interesting things I think you can look at. On the corn, you did have a wedge formation on the corn. A lot of people have talked about it. I'm sure you've talked about it. You took out that 473 yesterday. That was definitely negative. There was a downward channel line that we bounced off of overnight, and I think that kind of led to a little bit of a technical recovery. If you look at the CFTC report, the funds are carrying their biggest short position, not a record, but the biggest short position in about 3 years. So you kind of took out a little bit of resistance and or support, and we didn't get follow through. And I think that kind of generated a little bit of short covering bounce. But, the reality is you got to get over that 10 and 20-day moving average to even make this market look more than just a turnaround technical action. We're not even close to those numbers. When you look at the fact that we're only 10% harvested, we probably got more harvest pressure to go. If we would start making new lows, everyone's going to tell you that, that wedge formation projects to 440 on that corn chart. And if you look on a fundamental argument, I think that's very legit. You're looking at 15% stocks to use. Historically, that is probably closer to $4 corn and $5 corn. So there is definitely some downward pressure potential out there. But, on the other side of the coin, you've got crude oil continues to rally. It's up near $90. Some of the other markets, cattle markets are, backed off a bit today, but they're at record high levels. Some of the other food items, OJ, are screaming higher. So you've got kind of an inflation play that's starting to come back in as well. So you kind of got a little bit of a battle, I believe, in the corn market of kind of a negative fundamental setup for the corn carryout numbers going into harvest versus maybe more of a macro play that as inflation is just it's having a hard time dying, I guess I would say. And, that might bring some money back in. Not what the Fed wants to see, but that could be what happens.
I'm glad you brought up crude because typically I feel like crude is very supportive to the overall commodity sector. And you got crude oil getting up to new highs here, $91, $92 a barrel, yet we're not seeing a whole lot of movement in this grain market. So I guess I find it interesting that crude hasn't elevated us, but then you think about a high US dollar and all those things that are kind of headwinds. I guess it makes sense, Jim. It's just an interesting side note, I think.
Oh, I think it makes sense. And I think it's something, Jesse, you need to kind of keep an eye on. You may be ahead of the curve a little bit. Maybe this high crude isn't something that's going to drive the investor money in just yet, because the investor money does know we're just beginning harvest. Just you drive around the Midwest and you can see, we've got to get through that harvest pressure. But, what might be interesting to see is we get through the end of September, we get into the fourth quarter. Maybe that's when you start seeing that investor money coming in, especially when the market sees how the Fed, how the market in general reacts to the Fed here tomorrow, or I guess technically tomorrow on Thursday is when they're going to release it. If the Fed says, hey, I'm worried about inflation coming back in. And I think that's where they're going to be. They're not going to raise interest rates, I don't believe, but I think they're going to really talk about, hey, if you're looking for us to cut interest rates anytime soon, That's not going to happen. They're very worried about what happened in the 80s. If you look what happened in the 80s, we had a big run up in the 70s in inflation. They got it under control, and then we had that secondary explosion that took it up to the record levels everyone talks about. So the Fed, I think, is very cognizant of what happened then. So they are not going to let their foot off the neck of inflation. But there's two things they can't control. I mean, raising interest rates, it may slow down people buying cars. It may slow down people going out to eat on their credit cards or going on vacation, maybe buying a home. But the reality is food prices are going up because Mother Nature is just not cooperating. We are going to have a big corn crop. Bean crop looks very, very susceptible to me. We'll dive into that in a second, I'm sure. But that bean yield could definitely go lower. And we've got a very tight U.S. supply. World numbers aren't quite as tight, but they're tightening a little bit. World wheat numbers are the world's exportable supply. The people who actually export wheat, Jesse, their stocks to use levels are the lowest in 10 years. And then you've got a drought going on in Argentina. You've got dryness in Argentina and in Australia. So the world wheat supply is getting tighter. That could drive food money right back into the wheat market again. And then, like I said, energy, you made a good point. The Russia and OPEC are doing everything they can to cut production. It's interesting enough. I saw a stat. If you look at energy as a whole in the United States, combined oil, nat gas, all the quote unquote energy we produce in the U.S., we're producing more energy than we ever had in the U.S. And prices are still high because the reality is the world producers are backing off quicker to offset our increases. And that's something the Fed really can't do anything about. I mean, they can't force the Saudis to pump more. They can't force Russia to pump more, or any of those countries right now. So, the best they can do is hold that interest rate high to try to slow down the economy a little bit. But that, like I said earlier, that might bring some spec money in down the line once we get through this quote unquote harvest low.
Great points. And you mentioned soybeans. You read my mind. I want to segue there a little bit. I know Brazilian Brazilian planting is starting on soybeans, but you're right. I'm hearing some susceptible yields here in the U.S. on the bean side. That balance sheet is much tighter. So I have to think that folks could still be a bit bullish in this soybean market overall. Jim, what's your thoughts?
I think you should be bullish. I think you have the opportunity to be bullish. Yeah. We'll know a lot more, I think, in about 10 days. You're looking at carry out, folks, around 220 million bushels. To get there, they had to cut exports and they had to cut crush to keep that carry out at 220 on this August WASD, the September WASD number. Now, if you look at the yield, it's 50.1 bushels. That's still higher than it was a year ago. If you look at crop ratings, we're lower than a year ago. I would guess most producers out there that I talk to say, hey, we definitely had worse finishing weather than we did a year ago. So if you lose a bushel and a half, 2 bushels off this crop, and time will tell if that happens. But if that's the case, you lose 2 bushels, that's 180 million production. Where are you going to do it? If you take 180 million off the crop, your projected carryouts at 220, you will have to bring this market higher, I believe, to ration out demand. Now, why is it not doing it now? Because they're only 5% harvested right now. And I think the market's just kind of in a wait and see mode to see where it is. And I think we'll have a clearer picture in about 2 to 3 weeks as harvest, I think, for beans is going to ramp up quick. The other thing we need to kind of keep an eye on, you mentioned South America is dry. That is not a problem yet. They've got a huge window to plant, but it's something we need to be watched, and maybe even for the corn, because a couple of years ago, Jesse, you might remember, they had the same problem. They had a very dry issue trying to get the bean crop planted. They planted it late. They planted the corn crop late. The corn crop ran out of water, and that's one of the years we had a very strong bull market. So, when the government places those balance sheets out for the world numbers, they're essentially not using the production for this past year. They're using production for this upcoming growing season. So it can change dramatically if, South America stumbles, and we'll see what weather does. I mean, look what our weather this year. We had a very strange season where we went to a drought that, as far as I recall, not a lot of weather guys were forecasting. Then we got a lot of rain. Then we went right back hot and dry again. I mean, it's just, the weather is weather. We just don't know. And if it does not cooperate, the balance sheets can change. Like I said, the world balance sheet, the wheat market's not showing it, is already tightening up. And like I said, the bean balance sheet, the U.S. is tightening very, very quick, and the world could tighten even quicker if South America would have a second problem like they did this year in Argentina.
We're having a conversation today with Jim McCormick from agmarket.net. Jim, I'll ask the question, a two-part question here as we kind of wrap up our grain discussion. I'm hearing a lot of chatter of folks saying they're going to sell beans off the combine, store their corn. That's kind of the prevailing theme I'm getting. Are you hearing a lot of the same? Any thoughts to that? And then also, anything changed as far as marketing 24 crop at this point for corn and beans? So kind of a two-part question there for you.
As for your first part, selling beans out of the field and storing corn seems to be the trade du jour this year. I've heard that. I've heard other analysts trying to push that. I think the odds are if you can store grain on farm for a little bit, it's probably going to pay. I would expect the basis to firm up a little bit. The producers haven't sold a lot of grain this year by all accounts, Jesse. So the elevators don't have a lot of coverage. The end users don't have a lot of coverage. So I do think, once we get done with this harvest, you will see that basis snap back a little bit on the corn, maybe a little bit quicker than the beans potentially. But I think you got to be very cautious about if you're storing that grain on farm or if you're going to store it in the commercial side, because it is going to be very expensive to store grain this year. You normally have your commercial, you have your normal charges, but the big change this year is the interest rate and the cost of your money. Right now, we're calculating the average monthly storage fees just on interest, even on farm, is going to be around 4.5, 5 cents a month. So if you store corn for 5, 6 months, you're going to need 25, 30 cents increase in basis just to cover that cost. Beans, it's even worse. And that's why I think you're seeing guys choose to store corn than beans. If you want to store beans, it's going to cost you about 10, 11 cents a month in interest. So if you even store beans for 5 months, that means you're going to need about a 50-cent increase in basis just to cover that storage cost on farm. So I think you are seeing a little bit of a move there. Now, producers, I think if you are selling beans, it may be worthwhile to consider re-owning them, like I said, until we get a clearer picture, or if we start seeing this picture tighten up. I do think the beans could have a very bullish story if the yields aren't there. It's a big if, but my personal opinion, I'm leaning to think the yields are going to shrink back just based on how quick this crop turned and just how hot and dry we were across the Midwest. 24
marketing, any thoughts there real briefly?
Real quickly on the 24, especially in the corn, you still got 24 corn over $5. We would encourage producers to try to lock that in, especially if you're locking in fertilizer. A lot of clients of ours have started to lock in fertilizer. Our viewpoint is if you're going to lock in the fertilizer, you need to maybe sell enough bushels to cover that cost. I mean, there is a bullish story out there. Like I say, the inflationary story potential could be there. If beans would really go strong, I think they could pull corn up. But there's also a bearish story out there. I mean, we have too much corn available at this point in time. A 2.2 billion carryout historically, like I said, is closer to $4. If we get into springtime, there is a real legit risk that if South America's got a good crop, we're not competitively priced in the world market. Our prices may have to go lower than anybody thinks to stimulate demand. So if you can lay off risk of the 24 crop, buying puts, selling some grain to guarantee profit, I'm going to highly encourage you to do it. And if you are in that mode of storing corn into next year, I would encourage you to even maybe consider some risk off of the corn you're going to put in your own bin.
All about risk management, and definitely a lot of things to consider. Jim, livestock trade, cattle, hogs, fairly mixed bag there on Tuesday. This cattle market, though, continues to just churn at recent highs and just it continues to hold up here at lofty levels, Jim.
It's pretty amazing. Well, the tight supplies are there. We know the cattle and feed report is going to show us tight supplies again. It's not an unknown. I think you got a lot of guys who are tempted to sell it, but they want to see if they can get that 200 print. It seems like that is the market's goal, to do it sooner than later. But it's like I said earlier, I think you got to be a little bit cautious about the consumer. I mean, right now the supply is tight, but the goal of the market, unlike the corn market, which may go lower to try to stimulate demand, the cattle market's moving higher to get to the point where you're going to see demand back off. Box beef has backed off a little bit, so maybe we're starting to see a little bit of the consumer break. And if, as you get into the holiday season, it's going to be a two-edged sword. Traditionally, that's a very strong time of year. People will, holidays, Christmas, New Year's and all that. But if the economy is really shrinking and we're into, and we've got problems with the economy, student debt loans, moving away from the high-priced beef could definitely, be one of the first easiest ways to cut spending. Now, one other note I do want to bring in, I meant to mention, Jesse, is the government shutdown.
Yeah.
A lot of people say, what does that matter to me? Well, I know you could argue that's probably good, that's bad, but something we need to be cognizant of. If there is a government shutdown here at the end of the month, there's a very good shot we're not going to get the October WASD numbers. And if we don't get the October WASD numbers, we are going to be flying blind on these yields, maybe until November. And, that could be good or bad depending on where it's at. But that is something that, we need to kind of be cognizant of just in the overall, livestock and grains, what could happen. So keep your eye on the headlines out of Washington.
That is an extremely important point that I was not thinking of, and it's definitely something we need to continue to watch. Jim, before we let you go, anything final you want to share or reiterate with us today?
Right now, I'm just going to reiterate, our mantra. It's not price, it's profit. We're going to encourage, producers out there to lock in profit when they have the opportunity. We saw what happened this year. Volatility gets really extreme. It's kind of dead right now. But don't be afraid to do, to book those profits. As a whole, it does feel like we're in a rebuilding mode in general in supply side agriculture. A couple good years in the U.S. and South America, prices more than likely be a lot lower than they are now. That's the cycle of agriculture, and you want to try to be able to lock in your profits now so you can ride out the downward cycle if that's the cycle we're in.
A lot of great intel and insight that I know you guys have available online. If folks want to check it out or reach you guys for a conversation, I know they could do that very easily. How can they get a hold of you, Jim?
Pretty much the best way to reach Ag Market Team is go to agmarket.net. Go ahead and subscribe to a free trial of our research.
With that, Jim McCormick, agmarket.net. Always a pleasure to have a conversation. Thanks for the time. We'll talk to you soon.
Thanks for having me on, Jesse.
That's going to do it for our show today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.